Hi, I'm Samir Jain. These days, I've been thinking that if I was a CEO of an asset management platform, how would I actively manage in a hypothetical crisis? So, I would be fixated on preserving client capital, but also keeping an eye out to take advantage of new market opportunities that will come to manifest themselves. So while every crisis is different, there are certain things that one can reasonably forecast. One would expect a dramatic increase in unlevered yields in a crisis. One would expect increasing global systemic risk. Most of these markets now are very tightly coupled, and the common denominator is COVID 19, which is a driver of systemic risk. We would inevitably enter into a period of extreme volatility. We would have volatility spikes, we would have volatility clustering, where large changes follow large changes. One would also expect asset prices to deteriorate significantly. Asset prices have pretty much held up thanks to the federal put, but that changes dramatically in a crisis. And even though we are flush with money today, access to leverage is going to dramatically reduce in a crisis. And this virtuous cycle of being flush with capital will suddenly turn vicious. Across the board, you'll see firms de risk, one will see liquidity contracting, and banks that have held up so well until now, too are going to de risk. They too are going to write down the value of their risky assets. And in the corporate world, and actually even in governments, one would expect accelerated defaults and subsequently lower recoveries. So these are things that happen in pretty much most financial crisis, in most credit crisis. So as a firm, there are certain things that one can do, recognizing full well that different firms have different lines of business, but there are certain commonalities. I would start aggressively reducing risk in substantially all products. I would start selling products, even if it means taking a small haircut initially. If I was running muni funds, I would reduce monoline exposure. If I was a bank platform, I would implement a capital adequacy framework. I would ramp up stress testing. If I was running hedge funds, I would start reducing my leverage. I would say that, hey, we are not going to run our funds on borrowed money anymore on a net cash basis. And if I have funds that I have seeded that haven't really performed much too well, I would see no harm in liquidating them and returning money to my investors. Counterparty risk really increases during periods of such crisis. So I think counterparty risk with regulated banks is fine, but it ain't fine with investment banks or if your counterparty is a broker dealer, which for the most part it's going to be. So one will have to renegotiate and terminate existing trading agreements. But of course, even during the heart of a crisis, you would always find good opportunities. And I really don't know what those are, but those will take many forms. So one should also proactively think about launching new strategies and managing your existing capital to capture this elevated volatility that I just alluded to. So one can set up new funds, new credit funds, global macro fund. Global macro calls tend to do extremely well during such periods of uncertainty. One would look at emerging markets. One would look at, for example, distressed debt. But each of these have their own pros and cons. So for example, if you're in the corporate structured credit business, you need to be very careful about margin calls because we saw in the last crisis a number of credit funds were forced into liquidation. They went out of business if they were unable to meet those margin calls. So it's very important that your fund does not suffer from margin calls that you cannot meet. Also, defaults are going to go up. So one needs to correctly project realized losses and no longer rely on history. Even those first loss tranche portfolios are going to get hit. And inevitably, during these periods, distressed debt, while it brings a lot of opportunity, if you already have a distressed debt fund, you're probably going to get into trouble. Right now, the mortgage markets have held up, but in the last crisis, mortgage markets suffered massive losses. So you need to have proprietary methods, if you don't already have them, to forecast significant increases in delinquencies and project losses that you should be able to monetize. And it's best to have a mortgage fund that has the ability to go both long and short. Likewise, global macro will bring a lot of new opportunities. As far as emerging markets go, I don't buy into this decoupling story, and I would start reducing risk. I would start going more and more into cash. Munis, government finances are going to get hit a lot. They already are actually, as local economies have seized up. So I would reduce my exposure to muni funds. If I was running private equity or say infrastructure fund, I would start conservatively positioning the fund and keep very strict limits on when and why am I going to draw down my undrawn commitments. It's important in such periods to keep your dry powder dry so that you're able to pursue acquisition opportunities that will come at attractive valuations as haircuts increase. So my portfolio companies are going to have much more conservative capital structures if we ever get into such a crisis. One would reduce outstanding debt and one would refinance to extend the tenor of debt maturities. So net debt as a percentage of enterprise value is something that would become extremely important. And while my desire would be to focus on realizations, I would be very realistic and know that realizations don't happen during such crisis. But it's very important to avoid significant liquidity, NAV deterioration issues, because that is what inevitably happens during crisis. How would one position oneself for growth? That's a hard one, actually. But the one thing that all of us need to get in is the mindset that we need to be perennially raising money. And not raising money only when we reach the end of our investing cycle. So we need to actively target capital raising, whether our channels are high net worth, ultra high net worth, or we have an institutional focus. Teams become quite important, so to have very highly aligned incentive allocation, compensation structures. The other thing that most firms really don't have is this crossover between public and private. So any firm that has derivatives expertise can create very unique investment structures during periods of such crisis. I guess what I'm trying to say is the ability to look across major asset classes, capital structures, financial engineering acumen. These become very highly prized when one is in a credit crisis. And of course, to have an investment approach that is very tightly coupled with a risk management function that is not about diligence and dotting the I's and crossing the T's, but one that is highly effective in a volatile market. So essentially, if you don't already have an institutional quality operational risk infrastructure, you should absolutely be investing in building one. There you'll find that measuring tail risks, avoiding leveraged only carry trades, having adequate capital adequacy, all of these things that right now might not appear to be as pressing suddenly become top center stage during a crisis, and it's far better to prepare for it now. Those were just some thoughts I had. Thank you for listening in. Bye bye.